Market positioning, particularly in the context of call and put walls, refers to the collective stance of market participants, especially in options trading, and how their positions can influence price movements. The terms call walls and put walls describe significant levels of options open interest, which is the number of outstanding contracts that can act as psychological or technical barriers for price movement. Call walls. A call wall forms when there is a large concentration of open interest in call options at a specific strike price. This creates resistance as market participants who sold those calls may need to hedge their positions, limiting upward price movement. A call option is a financial contract that gives the buyer the right, but not the obligation, to buy an asset at a specified strike price before or at the option's expiration date. Why call walls matter? When there's a large amount of open interest at a particular strike price, it can act as a resistance level because market makers who sold those calls may hedge their positions by selling the underlying asset as the price nears that strike price, suppressing further upward movement. Investors might avoid pushing the price higher because those call options will gain significant value if the price crosses the strike price. Example: if there's a large number of open call options at a strike price of $50 and the stock approaches $50, it might struggle to move above this level. This is because sellers of the calls may sell stock to stay delta neutral, creating resistance. Put walls. A put wall occurs when there is a significant concentration of open interest in put options at a specific strike price. This creates support as market participants who sold those puts might hedge their positions by buying the underlying asset, which limits downward price movement. A put option is a financial contract that gives the buyer the right, but not the obligation, to sell an asset at a specified strike price before or at the option's expiration date. Why put walls matter? When a large number of put options are outstanding at a particular strike price, it can act as a support level because market makers who sold those puts may hedge their positions by buying the underlying asset as the price approaches the strike price, preventing the price from falling further. The likelihood of the asset falling below that strike price becomes lower due to the accumulation of support at that level. Example: if there is a significant concentration of open put options at $40, as the stock nears $40, it may find support because sellers of the puts would be buying shares to hedge, preventing the price from falling below that level. How investors use call and put walls. Identifying key levels of resistance and support. Call walls as resistance. Investors use large concentrations of call option open interest at certain strike prices as potential resistance levels. If a stock approaches a major call wall, traders may anticipate that the stock could struggle to move higher. Put walls as support. Similarly, large open interest in put options can create support levels. If a stock approaches a key put wall, traders may anticipate the stock finding support and bouncing higher. Options expiration impact. As options expiration approaches, the influence of these call and put walls becomes more pronounced. Gamma hedging by market makers, adjusting their positions to maintain delta neutrality around key strike prices, can intensify price movements near call and put walls. Pin risk. Stocks may pin to the strike price with the largest open interest as expiration approaches, meaning the price may gravitate towards that strike level due to hedging dynamics. Hedging behavior. Market makers and large institutions that sell options need to hedge their positions to remain delta neutral. As a result, they buy or sell the underlying asset as the price approaches significant call or put walls, influencing market momentum. Volatility prediction. Traders analyze call and put walls to predict future volatility. Large call walls might limit upside volatility because sellers will sell shares as the price rises toward the strike price. Conversely, large put walls may limit downside volatility. Combining with other technical analysis, investors often combine the information from call and put walls with other technical indicators, such as moving averages or support resistance levels, to better gauge the strength of the market at critical levels. Example, in real-life trading. Suppose XYZ stock is trading at $45, and you notice that there is significant call option open interest at the $50 strike, creating a call wall. As the stock approaches $50, you might expect that upward momentum could slow down because market makers may sell stock to hedge their positions. This could create resistance at $50, and you might adjust your strategy by either selling your position or taking profits before the stock hits this level. On the other hand, if there is significant put open interest at the $40 strike, you might expect support near $40 because market makers might buy stock to hedge, preventing the price from falling much below this level. You could use this as a potential buying opportunity if the stock approaches $40. Key takeaways. Call wall equals large open interest in call options at a certain strike price, creating potential resistance. Put wall equals large open interest in put options at a certain strike price, creating potential support. Hedging behavior by market makers can intensify price movements around these walls, influencing how a stock reacts to approaching key strike prices. Gamma hedging and pinning effects are particularly strong near options expiration when call and put walls can heavily influence market behavior. Investors use call and put walls to anticipate potential turning points, manage risk, and time entries and exits in the market, especially around key expiration dates. Investors can use information about call and put walls in several strategic ways to enhance their trading decisions. Here are some practical applications. First, let's talk about identifying support and resistance levels. High open interest in put options at a particular strike price can indicate a support level. If the price approaches this level, it might bounce back due to buying pressure from those hedging their positions or traders looking to capitalize on potential reversals. Conversely, significant open interest in call options can signify a resistance level. If the price nears this level, it may face selling pressure, as option holders might sell to realize profits or limit losses. Next, let's discuss guiding entry and exit points. Investors might look for opportunities to buy when the price approaches a put wall, expecting a bounce due to support. Similarly, they might enter positions when the price dips toward these levels. When the price approaches a call wall, investors may consider selling their positions to lock in profits, anticipating potential resistance. Conversely, if the price approaches a put wall, investors might exit bearish positions. Assessing market sentiment can be quite insightful. A strong call wall indicates that many investors are optimistic about the asset's future, which could suggest potential price increases. Investors might interpret this as a signal to enter long positions. On the other hand, a significant put wall reflects bearish sentiment among investors. This can prompt investors to either hedge their positions or consider shorting the asset. Options trading strategies can be diverse and quite effective. Traders can utilize call and put walls to set up straddle or strangle strategies. These involve buying both call and put options at different strikes around the current price, capitalizing on anticipated volatility as the price approaches these walls. For those holding the underlying asset, selling call options at a level near a call wall can generate income. Conversely, selling put options near a put wall could be a strategy for acquiring shares at a lower price. Volatility forecasting, anticipating price movement. Significant open interest at call and put walls often indicates where volatility might increase as the price approaches these levels. Investors can adjust their strategies based on expected price swings. Risk management apply. Understanding where call and put walls lie can aid in setting stop-loss orders and managing risk. If an asset approaches a call wall and begins to reverse, an investor can exit before potential losses deepen. Monitoring market dynamics. Flow of funds. By tracking changes in open interest, investors can gain insights into market dynamics and how traders are positioning themselves. A sudden increase in open interest at certain strike prices can indicate that investors are making significant bets on price movements. News and events. Investors should pay attention to upcoming events, earnings reports, economic data releases, and so on. That might influence the asset's price and consequently the behavior around call and put walls. High volatility may lead to changes in these walls. Combining with technical analysis, technical indicators, investors can integrate call and put wall analysis with other technical indicators like moving averages and RSI to confirm their trading signals and enhance decision making. Chart patterns. Observing how price interacts with these walls on charts can provide additional context. For example, if the price breaks through a call wall, it could signal the beginning of a new bullish trend. By understanding and leveraging call and put walls, investors can make more informed trading decisions, identify potential opportunities and risks, and better manage their portfolios. It's essential to combine this information with other forms of analysis and risk management strategies to achieve optimal results.